Ticker symbol MORN is down over 1% in the past year, and today we'll be looking at a highly diversified company which is developing a moat. This company has experienced explosive bottom line growth in the past couple of quarters with a 162% year-over-year net income growth. And this is mainly because of an incredible net margin expansion in the last year. So today we'll be looking at none other than Morningstar, a financial services provider. In their annual report, they state that they deliver their perspective to institutions and individuals in order to allow every investor to make better informed decisions and realize success. Now, I'm sure most of you know Morningstar, as I did, through their website, which is a very comprehensive website allowing you to do a lot of research on stocks and also indices. However, I discovered that they offer a lot more than that. Just because they offer so many solutions, I'm going to go over the 5 categories that I made, taking information from their annual reports. Starting with Morningstar Data and Analytics. Over here, they offer tools which provide investment insights, robust analytics, and tools for planning investments. Here, we could fit some of the criteria and some of the utilities that Morningstar website actually has, which is a free-to-use website, but also offers a premium plan, which has a lot of subscribers. Then they have a pitch book, which is a software that provides extensive data and research on private capital markets. These include venture capital, private equity, private credit, and anything related to mergers and acquisitions. I believe that this is one of their key drivers because it's a very unique solution. It allows a lot of consulting firms or a lot of investment banks to have extensive data on companies where it's very hard to actually obtain data, which is the private market, meaning any company which is owned by someone else instead of trading in the stock market. And believe me, over the past couple of years, this private equity sector has been booming. Next, we have Morningstar Wealth, which offers model portfolios, wealth platforms, and even individual investor tools such as the website. It could also fit in here as it allows you to track your portfolio and just analyze how you're doing. But additionally, since they offer a program of asset management, they currently have close to $60 billion in assets under management, and this is as of 2023. Next, they have Morningstar Credit, where they are one of the leading provider in credit ratings. They include a company which is called DBRS, which is the 4th largest credit agency globally. So in this sector, Morningstar is competing against huge companies such as S&P Global, Moody's, or even Fitch. And last but not least, they also offer managed retirement accounts, fiduciary services, and customized retirement products, where they have over $230 billion in assets under advisement in 2023. And when you add all of these solutions together, you have a company which has great financial values, with a 20% return on capital employed, where our threshold usually sits at 15%. Then they have an interest coverage ratio of 10 times, which is right where our threshold is, and they have a cash conversion of 76%. Then they have a gross margin of 60% and a net margin of over 15%, which is generally our threshold. And this is exactly what I was talking about. The revenues have been growing. They accelerated at the second half of 2023, and since then they've been increasing at a pretty consistent pace. But where the growth has really been is with that net margin expansion. If we take the evolution from March 2023 all the way up to December 2024, this has been incredible. And this is the main reason of why their net income has surged by over 160% in only 1 year. And as we always say, efficiency ratios mainly follow net income, which is why we can see that they dipped to a low, which is March 2023, and since then they have recovered at a pretty fast pace, with return on invested capital, which is the one we like to focus on in this slide, settling back over 40%. And when we look at their balance sheet, it is great to see that their assets are way over their liabilities, and that in the past 3 years, actually, their liabilities have been decreasing while their total assets have been maintained. But if we look at their fundamental analysis, this company gets a clear 6 out of 8 ticks. Starting off with a low liability risk due to their 10 times interest coverage ratio, then they have a solid balance sheet as they're able to pay all of their short-term liabilities only by using their current assets. They pay a very solid dividend, which we will talk about next, and they're able to conduct share buyback programs in order to reward all existing shareholders. Additionally, despite not having consistent cash flows, meaning that it's very hard to predict what their cash flow will be in the following quarter, they are able to grow these free cash flows when we look at it from year over year. And this is mainly allowed due to Yes, their organic revenue growth, but mainly due to that incredible margin expansion. And just a note, by organic we generally mean that they don't need acquisitions or mergers in order to improve these values. And now the two most important factors from this slide, which are pricing power and their existing moat or their competitive advantage, I believe Morningstar meets them both to a certain extent. When it comes to pricing power, I usually define this as being able to raise prices at a rate which is above inflation without losing too many customers. When it comes to solutions such as asset management, this is very hard because you generally price your services as a fee of the total capital that you're managing. For example, a 2% of all of the capital that you're managing. The main way of increasing your revenues if you're operating in this segment is by managing more funds. Because the moment you increase that 2% to a 3%, for example, well, customers are very sensitive to those price hikes. And since there are hundreds of thousands of companies in that space, if they see another company which has a similar offering, which is very likely, but has a way lower fee, then you are very likely to go to the new company or at least give it a try. However, when we look at their other services, specifically the subscription services such as either PitchBook, which was the insights for the private market capital, or their online investing platform, this does have a lot of pricing power because these subscriptions are generally not priced at a very high point because it's a service for finding data. However, this means that this cost does not represent a high percent of the cost of institutions or of individuals actually using this tool. In fact, I believe that they offer a lot more value than what they actually cost. So in this space, I do believe that they are able to, and they have been able to, raise prices without losing too many clients, because these clients, luckily, are not very sensitive to price hikes. But now this same division happens when we look at their existing moat or competitive advantage. In sectors such as the credit rating, they have a very large existing moat or competitive advantage because DBRS is one of the largest credit rating institutions, meaning that first of all, they have a lot of repeat clients because the moment you get your credit rating done by one agency, chances are that if you're satisfied with the service, you will become a repeat customer because it simplifies the whole collaboration process. Additionally, when companies want to get their debt rated, one of the main factors that they will look for in a credit rating agency is the brand recognition, because at the end of the day, you only get your credit rated in order to attract investors, and investors are only going to believe the credit rating from the largest and most well-recognized credit rating institutions in the world. However, on the other places such as their website or their retirement accounts, since there are so many similar offerings around the world, they don't have a very high existing moat in these sectors since there are not as many barriers to entry there. I'm happy to point out that they have been paying a very stable and growing dividend for a very long time, and despite only sitting at a 0.57% dividend yield, this is trading at the lowest dividend yield it has been trading for in the past 4 to 5 years. They do have a payout ratio of 19%, which is very low, and it gives confidence to investors that Morningstar will be able to either raise their dividend in the short term, or it just gives security that the company will be able to maintain this dividend for a very long time. And when we look at their valuation analysis, we can see that in March, the price to earnings peaked, but this is because their net income was at an all-time low, and now their price to earnings ratio has normalized and is trading at the lowest it's been trading for the past 3 to 4 years. We can also validate this with their free cash flow yield, which is a 3.52%. When we compare it with the 3% long-term inflation, it does deem this company as that it may be trading at an undervalued price. And now, I mainly see the worsening competitive landscape. As I mentioned, this does not focus on their credit rating agency, but it does focus on their website and their asset advisory services, because there are very low barriers to entry in these spaces and they're very lucrative businesses, which is why a lot of competitors have actually been emerging lately, and which is why Morningstar has to be one step ahead every single year in order to deliver higher quality and retain their current clients. On the other hand, I see that this company has a high cyclicality risk because although they have a big portion of their business that is dedicated to subscription services, which is amazing, they have another big chunk of their business which is dedicated to very cyclical business. Exhibit A, DBRS. Credit rating agencies go up and down depending on where interest rates are, because it is very hard for companies when there are high interest rates to issue new debt and rate them with credit rating agencies. However, if interest rates are actually decreasing, then it is expected that DBRS and all these credit institution businesses will bring in a lot more revenue than previously. And now please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company does have a strong competitive advantage in some of their business segments and that they have higher return on capital employed, meaning that they know how to create value for the investor. However, they are missing that predictability when it comes to their cash flows. So, although I believe that this is a good company, I believe that it could be a good investment, especially if interest rates decrease. And now, as always, this has been the Cash Flow Compounder. Thank you for watching, join the free Patreon for extra content, and I'll see you in the next one.